This meeting is being recorded.
Folks, you have probably heard the following names, and if you haven't, do a quick Google search and you know why it's important to have this conversation. Michael Burry, Peter Schiff, Dr. Doom, also folks like Tom Lee, Jack Bogle. These folks are often called perma bears or perma bulls. And as my good friend Taylor says, they're both idiots. It doesn't pay to be perma bulls or perma bears, but let's talk about it. What's he talking about? How you doing, Taylor?
Doing great. Thanks so much for having me. I totally agree with that comment. Well, I made it, so obviously I agree.
Yeah, that was a quote.
Yeah, but no, listen, market dynamics change. The economy changes. And when the news change, you have to change along with it. I'm not saying take your, investment philosophy and throw it out when you get a bad news from CPI print and inflation or whatever it is. But at the end of the day, you have to be able to manipulate things in one direction or the other to take into account what's going on in the environment. Don't put your head under a rock and live under a stone. You have to know inflation took place in 2022. If you don't, then you're lost and you don't know what you're doing from an investing standpoint. So yeah, you can't always be all on the gas and you can't always be all on the brake or in reverse on the gas, if you will, saying things are going to, doom and gloom all the time.
Yeah, I think it's really interesting as somebody who's been watching the market, because I watched the market from the sidelines for 20 years. After getting burned and losing 80% of my, I didn't touch it. It's like, fuck, forget it. I can figure out real estate. I'm going to go there. Now I'm lucky enough to have a little scratch and I'm putting some money to work. But as I'm doing that, it is so interesting to see people that I'll call broken clocks, right? They build a name, they get one thing spectacularly right, and then they never change. I did a video like 2 years ago on Cathy Wood, and this was in her heyday when she was the #1 portfolio manager 2 years in a row. About a week after that declaration, I warned people that, folks, this is not going to end well. She has been taught not to change her methodology, and 2 years later, she hasn't. Last year, I believe she was reported as the worst portfolio manager. And oh, by the way, now, if you blend those 3 years together, she's down 5%. So all of that is gone because she didn't change with the market. Cathy Wood won because she was betting on an asset with a huge tailwind of the Fed. And when the Fed said the pain is coming, she didn't listen.
Correct.
She could have pivoted. She didn't. And she has stayed all gas, to your point, and frankly, suffering the consequences as we speak.
And her investors are suffering the consequences.
Yeah.
And I say that with a very pointed reason, that last year, as she was down, I don't have the number off the top of my head, 77%.
64 something percent.
Whatever, 70%, call it somewhere in that ballpark.
Sure.
She saw net inflows. So people
did,
continued to buy into her ETF.
Buy the dip. Buy the dip.
Yeah, exactly. Buy the dip. Buy the dip. This tech wreck has to stop at some point, right? Which I actually think our next video is on that. But we'll talk about that. But no, obviously it didn't. And we'll talk about some of the reasons why it didn't and why it may or may not moving forward. But people continued to buy in because when it was down 20%, they were like, hey, 20% down is a discount to where it was, 2 months ago or whatever it was. And the pain just continued. And her largest holding throughout the entirety of the year was Tesla. And Tesla got absolutely torched.
Tesla, Roku, and I forget the other one.
You name it, the who's. She had the Peloton. I mean, all that
Coinbase,
all of the COVID type stay-at-home mentality stocks got absolutely whooped, and she continued to invest in them as they were innovators, if you will. But what we realized is that at some point, people are going to leave their houses and go back to some sort of normalcy, and the goods that were being produced by those companies weren't going to be consumed at the same rate, and she didn't change. And that is that's very tough to see. We talked about the last episode on Michael Bullard, one of the Fed presidents, and his
James
ability
Bullard.
to James Bullard, right, and his ability to input data or take incoming data and dictate how he looks at it and change his mind. You think about last year and people say, hey, I want to be all in on stocks all the time. Well, did it make sense to be all in on stocks when the Fed told us at the beginning of the year, we are going to take rates precipitously higher? That is the ultimate headwind that you can experience in the stock market. And when you look at that and say, hey, I still want 95% stock allocation inside my portfolio, what are you doing? That's not what they're telling you. That's not what history tells you to do. And that's not what they're telling you to do, as they tell you vehemently, we're going to slow down the economy.
Yeah. And again, people that don't change their mind create stories that people buy into. And as we talked about for 4 or 5 months, the Fed pivot was what Cathy Wood and Tom Lee and all of these perma bulls were saying. Just it's coming. The Fed's wrong. They're going to pivot. Look at the bond market.
Yep.
And people
Yeah,
fell for it.
It's funny how people aren't listening to the Fed. They just
I
they
know.
just don't listen to the Fed. They don't. I don't know if they think that they're smarter than the Fed or whatever it is. The Fed is the one that dictates where interest rates are going. They tell you every single time what they think is going to play out in the future. And
Every
they
other
tell you
meeting, they give you the dot plot, for heaven's sakes.
they tell you here is what we anticipate coming. And not only here's what we anticipate coming, because that might change based on incoming data, but they tell you their goal staunchly. We are going to stamp out inflation. And they tell you that over and over and over. And until we are incredibly confident inflation is in the rearview mirror, we're going to continue to raise rates.
Yeah.
Mark
And the reason I wanted to have this conversation is if you're following a perma bull or a perma bear, you should first of all recognize it. And I would always ask you to check their thesis. I think Cathy Woods is the clearest to see. She was unprofitable tech. They were based on revenues, not earnings. And a lot of them were zombies. And I think that was easy to check. Tom Lee, kind of the same thing. But Michael Burry, folks on the downside as well, Peter Schiff, they're consistent the same way as well. You could check their thesis and see if the economy is changing. And the reason I wanted to have this conversation with you is I'm about to change my opinion. And, for the last 6 or 7 months, I've been generally negative on the stock market. I have been the guy that said, hey, I see 3,200 as a real possibility.
Right.
And it's still out there. But I am getting constructive because I know the stock market is a leading indicator. And I think sometime in Q1, after we have earnings disappointments, right? We're already starting to see some of those. I might go shopping. I might put I will probably put most of my money to work that I've allocated in the first half, knowing that it may not be the bottom, but knowing, or in my opinion, thinking we're closer. So, I mean, I'm about to your point, looking at the data, looking where we're going. I see a rolling recession, but I don't, there's a chance we don't have any negative quarters GDP because a rolling recession is very different than the last 3 recessions. So I might get aggressive, or I don't know. I guess aggressive, put 50, 60, 70% of my allocated cash to work before June. That's what I'm thinking.
Yeah, I don't disagree. I think it's coming a little later. I think that what you see in this consumption number that I just printed is the fact the consumer is just going to start to slow down a little bit now. And the consumer really is just realizing for the first time that their pockets might not be as flush going forward. And so I think it takes a little bit more time to chew through the downside that we're going to see in earnings. But that said, I'm with you. And I've said this now for, 6 months or whatever. I think that midpoint of this year is going to be a really, interesting point to think about risk reward inside of stocks. And I think that the risk reward is becoming more asymmetric to the upside, whereas all of 2022, we said the risk for stocks is asymmetrically downside. And so I think that that's starting to change. I do think that these things, I'm more of, more middle of the year, but I do think that there's risk that it's prolonged even further out, more like and I'm not saying it's going to be a 3-year early .com type scenario playing out, but I think it could drag its feet along a little bit.
Yeah, I like it. That's why we have these conversations, and I'll be looking at the data every single day. Taylor, do me a favor. Where can people find you?
Yeah, find us at Life Goal Investments on Instagram is the best place to watch us.
Thank you, buddy.